Hi, my name's Griffin Bridgers. Today I'm here to talk about personal guarantees under Code Sections 2036 and 2053, and we're going to look at some guidance specifically from Revenue Ruling 84-42. Before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, to start out with, Code Section 2036 is kind of the backdrop of this ruling and this issue that creates the facts that we're trying to solve for. So what does Code Section 2036 do? Well, if you're not familiar, it causes property for which a decedent was once an owner but no longer is at the time of death to be included in that decedent's gross estate at its date of death fair market value, not the date of transfer fair market value. And that applies if the property was gifted away in part or in full. We'll see why in a minute. But the catch, how this has to be applied, is where the decedent retains rights equivalent to ownership at the time of death. So if there's retained control, benefit, use, anything like that. And I mention full or part gift because there is an exception which recognizes a bona fide sale. And if you can prove a bona fide sale, there is no Code Section 2036 inclusion, but it requires adequate consideration, which may not have to be exactly equal, but needs to be proportional at least. Sometimes you have to prove a non-tax reason for the sale as well. And if there's not a bona fide sale, but there was a sale, the decedent may be able to deduct the value of the consideration received from the fair market value of the property, but the value of the consideration received will be based on the value at the time of receipt when the sale was completed under Code Section 2043. Now, with that backdrop, personal guarantees are a looming issue. It's often the case with property that's transferred either at the time of transfer or subsequent to the transfer is encumbered by debt for which the decedent during life making the transfer had to provide a personal guarantee before or after the gift or sale transfer. So the question is, if that happens, if the decedent has a personal guarantee, could you claim an offsetting deduction for the debt that encumbers that transferred property under Code Section 2053? Because Code Section 2053 is a code section that allows deductions against the gross estate for claims, debts, mortgages, so on and so forth that were owed by the decedent. But it's that important point, owed by the decedent, that's going to affect this here. And really, the answer to our general question of deductibility is not so fast, according to Revenue Ruling 84-42. So we'll dive into the facts for a minute, but generally this ruling supports the idea that under Code Section 2053, a personal guarantee by itself does not create a debt or claim of a decedent's estate. So how does it do so? Well, let's look at the facts in this ruling. We had a decedent who transferred a remainder interest in a property to A and reserved a life estate for themselves. So because of that life estate, we know that the property is included in the decedent's gross estate under Code Section 2036. And after the transfer, but prior to the decedent's death, A took out a mortgage against the property, and the decedent provided a guarantee for the mortgage as required under state law, because A and the decedent are both technically owners and have to sign off on the mortgage in some form or fashion. However, A remained the primary payer of the mortgage and stayed current and was solvent. There was no risk of default on the mortgage. And the guarantee was really in no risk of being enforced because of these factors. So ultimately, decedent died, property was included in the gross estate under 2036, and the executor sought to deduct the value of the mortgage from the gross estate under Code Section 2053 due to the decedent's personal guarantee. So what happened? Well, long story short, the service did not allow the deduction. Now, generally, Code Section 2053A4 allows a deduction for the balance of a mortgage for any property that encumbers any property included in the decedent's gross estate. However, there's a number of prior cases and rulings that have kind of altered this requirement. This doesn't apply to just any mortgage, and the service really kind of set forth factors for determining why there might be no deduction. One, decedent's enjoyment of the property was not impaired by the mortgage. 2, the decedent did not receive any of the mortgage proceeds. And 3, at the time of death, the decedent's estate was not liable for any of the debt under the personal guarantee. In other words, the guarantee had not been enforced. So, with that being said, there's some other valuable tidbits here we can look at on when and how the mortgage might be deductible. But these factors focus on whether anything was actually paid in a way that depletes the gross estate. So that's the general theme here. Is the gross estate depleted by the personal guarantee being enforced? And if the answer is no, then there may be no deduction. So we can illustrate that with the permutations that the service gave under this ruling. One was the fact set, assuming that maybe the guarantee was enforced and the estate actually paid. Seems intuitive that there'd be a deduction there, but the service found there'd be no deduction in that circumstance. Why? Because A was solvent and the decedent had a right of reimbursement from A. So even if the guarantee was enforced, this is really just a subrogation type of thing where the decedent's estate can still recover the payments from A because A is solvent at the time. So actual payment and solvency seem to be our tickets here that we look at. So if A became insolvent and became delinquent prior to decedent's death, and the guarantee was actually enforced so that the estate had to pay amounts, then the amounts actually paid could be deductible. Not the full amount of the mortgage, but just the amounts actually paid. But here's the catch. The amounts actually paid would have to be reduced by the reasonable value of the right of reimbursement. So you wouldn't get the full deduction for what's paid. You'd get a deduction for probably a discounted value of the obligation of reimbursement by A, taking into account solvency and actuarial likelihood of the decedent's estate being repaid in that case. So there's more to come on this and some additional rulings I want to check out, but our big key takeaways here are that not all mortgages are deductible under 2053. Just because there is a mortgage, don't assume that you can get the deduction, especially in a situation where the decedent no longer owns the property, but instead the property is merely included in the gross estate under 2036. And this likelihood of there being no deduction is kind of bolstered not just by that fact that the decedent no longer owns the property, but that the decedent doesn't receive the loan proceeds or benefit from them in any way, shape, or form because ownership has been transferred. And even if a deduction is allowed, the right of recovery or reimbursement will reduce the amount of debt that you could deduct, which may be limited to the amount actually paid if that guarantee is actually enforced after the decedent's death. So solvency and actual payment matter both at the time of the mortgage and upon the decedent's death, and solvency isn't just enough. Now, I want to note real quick that if the property is upside down, 2036 may provide a benefit here because 2036 doesn't just apply to appreciated property, but that's worth another discussion for another time. But what's not clear here is whether a guarantee that does not require default as a condition to being enforced would change anything. Now, that's the case for most modern guarantees, but even if there's no requirement of default, delinquency, or insolvency, it's still likely that the IRS would look to insolvency and reimbursement as factors that underlie whether the estate can take a deduction for debts actually paid when that guarantee is enforced. As always, if you have questions or topic suggestions, you can send those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this presentation, and I look forward to seeing you in my future content.